Hello, and welcome to the Reed Supermarket Case Analysis presented by Team B. Presenting with me tonight will be Paul Schifano, Maria Sullivan, and Anna Iacono. Reed has historically competed in the high end of the retail market. They've competed with a company called Delfina. The high end has recently seen the introduction of Whole Foods as a player in that end. And then on the low end, Reed is being squeezed by Aldi and Dollar General, both of whom compete aggressively on price. So they've exposed a bit of weakness in Reed's model there. Reed's CEO is looking for 2 points of growth in the upcoming fiscal year. So we've been tasked with a couple things. One is helping them navigate these challenges. The second is helping to ensure that they meet the CEO's financial expectations. So tonight we will walk you through an analysis of the current market conditions and where Reed stands. We will go into a deep dive and really look at pricing, whether they should be at the high end or the low end. And then we will dive into our recommended strategies, so short-term and long-term proposals for Reed. Hello, this slide will walk us through a TOES analysis, a bit like a SWOT, but it pivots the data and presents strategic opportunities for the company. So Reed's strengths, we view them as store substance. They have a wide array of food and beverage offerings, a health and beauty section, a full pharmacy. Store form, the stores are aesthetically pleasing, they have long hours, they have outstanding customer service. Quality perception, Reed is perceived as having very high quality, second highest in the market, barely trailing Whole Foods. Weakness, price perception, customers perceive them to have high prices. And then price reality, they actually do have high prices. And then location. Two of the top 4 reasons non-customers do not shop at Reed are due to location. External opportunities, we identified a few here. Increased American health consciousness, the growth of private label merchandise, and then the last two all relate to innovation. So introducing online order fulfillment and meal kits, and introduction of an email insider club. And then threats, a weak economy, declining customer loyalty, the rise of low-cost competition, namely Dollar General and Aldi, and the rise of Whole Foods on the upper end of the market. And then the next section really is the intersect of these, and this is where we get into strategic opportunities. I do think it's important to call out here, this chart is not encompassing of everything that we're recommending. This is just showing available opportunities, and our recommendation will come later. So SO, this intersect asks, how can Reed use its strengths to take advantage of its opportunities? So here we said they can capitalize on the U.S. increase in health consciousness by adding to what is already a substantial array of product offerings. In effect, this means introducing meal kits to the health-conscious consumer. We also identified introducing online order fulfillment. They already attract the high-end customer with their convenient store hours and their outstanding customer service. This would add to that portfolio. The next intersect, ST. This asks, how can Reed take advantage of its strengths and in order to avoid real and potential threats? They can address the rise of Whole Foods by strengthening quality perception. It's a strength for both companies, but Reed is the incumbent. This means in order for Whole Foods to grow, they only have 1% of the market right now. They're going to have to outcompete Reed in quality because we know that Whole Foods is not going to go down the spectrum of price. So this would be a box-out strategy. WO, at this intersect, Reed asks itself how it can use its opportunities to overcome weaknesses. So here we said they could introduce an email insider club to overcome pricing weakness. This club would be available for those customers who opt in, but it will not be advertised in print. So it's essentially coupons, but it's emailed to the customer. And this is important because it allows the store to maintain its upscale image, which we think is important. The other thing here was addressing objective price weakness through introduction of private label food. So we think there's some opportunity for margin expansion here, and also saving your customer prices by offering a quality private label brand. And then the last intersect, WT, asks how can Reed minimize weaknesses and avoid threats? And here we said they can address poor price perception and poor price reality by lowering prices and letting the market know that they are doing so. This would be, in effect, meeting the low-cost competition at the bottom of the market. And with that, I turn it over to Paul.
Thanks, Mark. First, I want to look at Reed's market share objectives for next year. Reed's CEO set a goal to increase market share by 2% by 2011. So we examined the case if we wanted to compete on price with Dollar and Aldi, or if we wanted to commit our focus on new strategies to increase our sales and transactions. First thing I want to do is look to see what a 2% increase in market share would look like. Last year, Reed did $660 million in total revenue in the Columbus market. To increase 2%, we're looking at a total revenue of $754 million, or an increase of $94 million. These are aggressive goals set out by the CEO, but we do feel like we can achieve them. Okay, so let's look to see if we can compete on price. Well, when examining Aldi and dollar stores, we're looking at companies that are set up to exclusively compete at low-cost infrastructures. They represent a small part of the market, Aldi at 1.62% and dollar stores at 1.8%. They also attract bargain shoppers that are in a different customer segment than we're looking to attract. So speaking of bargain shoppers, let's look at dollar deals, which Reed is currently offering. The average price reduction per unit is from $2.70 to $1.50. If you look at the chart on the right, you can see that Reed's is losing money for every dollar deal transaction. These were created to drive traffic to the stores, which it has, but it's also attract bargain shoppers. If a customer buys 3 or more dollar deal items, the average price per transaction is reduced by 60%. So in 2010, our average transaction price was $31.48, which was 18% higher than the national average, a number that we're very proud of. But when a customer buys 3 or more dollar deal items, that average transaction price then drops to $12.59. All right, let's dive deeper into those transactions in the next slide. So let's dig deeper into the transactions. So last year in 2010, we did $660 million of total revenue. If you look at the 25 stores in the Columbus area, if you average that, that's about over $26 million per store. Per week, over $500,000 per store. So there's 2 strategies that we want to look at. One is increasing the number of total transactions per week, and the other is to increase the average transaction price. So in 2010, we averaged 16,000 transactions per week per store. If we increase that number, 2,300 transactions, maintaining that $31.48, that average transaction price, that would get us to the 2% market share increase. The other way we can get there is to increase our transaction price from $31.48 to $35.98. It's an increase of $4.50. In our view, we want to achieve some type of blend between the 2 strategies. So moving forward, our recommendation is Reed's does not compete on price with Aldi and dollar stores. We also are recommending that we discontinue our dollar deals. Instead, we want to focus on making Reed's a one-stop shopping experience for all of our customer needs. We're going to go into it in the next couple slides about including meal kits and selling wine in our stores that can help us achieve that. We also want to make Reed's more accessible. This would mean using an online platform and a delivery platform. We want to focus instead on our organic, produce, seafood, pre-made foods, and high-margin items. We also want to note that we expect the economy to improve. We're going to regain some of the price-sensitive customers that we lost in the last couple of years. So we've developed short-term and long-term strategies to achieve these goals. Now I'm going to kick it to Maria, who's going to follow through with those.
As Paul stated, I'm going to walk through our short-term strategy recommendation for Reed's. First, from a product perspective, we recommend that Reed's reduce the extensive inventories in certain products. We don't want them to necessarily lose the broad range of products that they offer to their customers, but we want them to gain the capacity that they need in order to offer a lower cost private label item. This will provide customers the lower cost items that they are looking for and also provide Reed's that loyalty brand that they want. You can only get these items at Reed's. Second, based on a study that we saw with Nielsen, we realized that Ohio is the number 4 state for wine sales. Therefore, we recommend that Reed's extend their current product platform to include wine sales. Based on Nielsen's study, the average national consumer when at a supermarket would spend $47 if wine weren't available. If wine was available at the supermarket, they would spend up to $75 per transaction. If we translate this ratio to the Reed's consumer, we're looking at $50 per transaction if they were to offer wine in stores. Looking at what Paul had shown for 2010 transactions, we're looking at over $1 billion in revenue. Even with $300 million of stand-up costs, we could still see Reed's obtaining that $94 million increase they're looking to get. This would also provide a more premium experience for their customers, so a one-stop shop experience so they can get an entire meal all in one location. Second, we recommend that Reed's does focus on price because it is a key item that was mentioned during the customer surveys. However, we recommend that Reed's offer an email insider club in order to give out dollar specials, or provide a status loyalty program. This will allow Reed's to gain loyalty from their customers as they build up status to get those better pricing promotions. Not only will the customers be getting the prices they want, but Reed's will be gaining loyalty and constant sales week over week. Lastly, from a short-term strategy perspective, we recommend that Reed's extend their current offering into delivery, homemade meals, online ordering fulfillment, and meal kits. This would provide a one-stop shop for consumers and an overall premium experience. According to Statista, in 2009 and 2010, restaurants and online ordering actually saw growth, specifically in food sales. If we assume that Reed's can acquire 0.01% of this market, their sales would grow by $50 million in 2011. Also, if we assume conservatively that there are going to be additional costs for wage labor, materials and products, and services, Reed's can still look to make a profit of over $30 million in the first year. If we combine the wine sales extension along with the delivery and homemade meals, we could easily see Reed's exceeding the increase of $94 million in that first year.
From a long-term perspective, we recommend that Reed's considers a merger or acquisition of Delfina as part of their 3 to 5 year plan. Benefits include capturing customers outside of Reed's current locations. 2 of the top 4 reasons for why non-customers of Reed's don't shop there are due to location, so this would help with that. We're also further protecting Reed's against Whole Foods' entrance into the Columbus market. At only 1.22% market share, Whole Foods is not a huge threat right now, but by gaining that getting to that 23.6% combined market share, we would be really setting Reed's up as the market leader in Columbus. Also, the addition of the 18 Delfina stores really expands our possible distribution network for the grocery delivery strategy we outlined. Finally, we'd capture synergies to spread costs amongst more stores and sales, specifically around corporate payroll and advertising. With corporate payroll, we should be able to see synergies in executives, in accounting, in purchasing, and other roles like that. With advertising, Reed's is already advertising in the Columbus marketplace, so there shouldn't be a need to use whatever Delfina is using from an advertising standpoint for that market. We are not outlining what the cost of the acquisition would be at this point, as we feel like that should be done closer to the execution of the strategy, because in the next couple of years, the valuation of Delfina could change. To recap, there are risks associated with our strategies, but overall, we feel like the rewards outweigh those risks. We believe that Reed's should continue to optimize and build a stronghold in the high-end market and provide new experiences for their customer to build on that exclusivity. We walked you through a SWOT analysis, a financial deep dive, 3 short-term strategies around product, pricing, and delivery, and lastly, I walked you through a merger and acquisition potential opportunity.